What's up, everybody? Welcome to the Life Cycle of a Trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we are going to cover an iron condor. Doing something a little bit different today, and we're going to be looking at futures. Futures trade 24/5, so you can trade these in the overnight session pre-market as well, while the option market is open from 8:30 to 3 p.m. Central Standard Time. So, and that's the option market for equity options. So with futures, you can trade them at any time. Futures, you can also trade the options at any time. So the futures, the outright futures, and the futures options trade throughout the morning and overnight session as well, while the stock market and stock option market is closed. So one of the futures that I trade frequently that I'm going to look at here is oil for that's /CL, which is the crude oil futures. Now, this contract is huge. It's 1,000 barrels notional value. So when you look at this price of $74.61, the notional value of this contract is $74,000. So a very, very big position if you are trading the outright futures. Now, we're not going to be trading the outright futures, but the options are very liquid and are something that you can get relatively small in. So now the multiplier on this position is going to be $1,000 per point, right? So your notional is 1,000, or your notional equivalent is 1,000 barrels of oil, which means that if you are buying something or selling something for $1, it's going to be $1,000 in actual values. That's your multiplier, which means that if you do a 1 point wide spread in the options, it's going to be $1,000 of total value here. So I'm selling it at 24 cents, which is $240 in value in credit, and $760 in max loss, because that's the width of the spread. The spread is 1 point wide, which is $1,000 in total value. So they do have half strikes here. So we went to the 37-day expiration. Of course, there are many different expirations that you can trade, just like stock options. But they do have half point wide spreads, so you can get even smaller if you wanted to here. Now, the other thing you have to keep in mind is that your risk here is more dynamic. You get span margin with futures contracts. So when you're trading futures, the capital that you put up front is going to be significantly less than what you would see on a short put in an equity option. Equities are margined to somewhere between 20 and 50% of the max risk on that position. So if you sell a put at the 100 strike on a stock, usually uses somewhere between $2,000 and $5,000 to hold that position, depending on the volatility in that underlying. With span margin, you get almost 6 to 8 times leverage on your position in terms of the actual capital that you put out there. So, $2,000 on that same put on a notional value perspective is really what you'd be using with span margin, or even less than that. The margin requirement for the position will change. It'll be dynamic. So it'll change as you get closer to expiration, as the underlying moves closer to one of your strikes. Changes in volatility will affect the span margin. So you have to keep that in mind when you are looking at futures options. They are highly leveraged, so don't get too crazy with them. So anyway, we're going to look at an iron condor here in oil. Oil has traded between the high 60s and up to about the 80 range here for the better part of a year. I think we continue with that for at least the next 37 days, which is what I'm going to play for here. So I'm going to look to go around a 20-ish delta for my short option, typical setup everywhere or in most of my other trades. So we're going to do the 69 strike short put. We'll look to go $1 wide here. And so we'll go to the 68 strike to define the risk. On the upside, we'll go to this 80 call. We'll buy the 81 here to define the risk. You can see I'm going to do this at a 30 some odd cent credit, which is $300 in value with a max risk of $690. That'll be our $1 wide iron condor here in the oil futures. So we'll get this on here. Let's try and get this filled at at 31 cents. See if we get filled here. No fill there. Go to 30 cents. Trying to get 1/3 the width. There we go. So we got filled at a 30-cent credit on this relatively delta neutral iron condor. We're playing for a little bit of sideways action through the next 37 days. Oil futures have come down pretty decently. They've also had a big run up. Couple weeks have passed. It's about as good as it gets for a short premium position, a relatively tight spread in the oil futures. So we're just going to close this one out and take the money and run. Hopefully we can get a 20-cent debit. I like to round everything to about $100 is what my profit targets are. There we go. You got to give up a penny, which is actually $10, so it's not small. But we just got filled on that. 90-cent profit, $90 profit on that iron condor in the oil futures. First futures trade in the Johnny Trader portfolio.